sideways motion seems to prevail. The slight strengthening of the USD seems to have activated gold bears given also the recent financial releases and monetary policy events. In this report, we aim to shed light on the catalyst driving the precious metals price and asset future outlook. Last week, the Federal Reserve remained on hold, keeping interest rates steady, as was widely anticipated by market analysts, yet the release tended to boost the greenback, which in turn weighed on the precious metals price. Fed Chair Powell reiterated on numerous occasions that despite remaining on hold, this does not mean that the Fed is done with hiking interest rates, thus leaving the door open for future rate hikes. As the median is now revised upwards by 0.5%, it may imply that the Fed may hike 2 more times by the end of the year, with rate cuts a few years out, according to Powell. Interestingly, the dot plot moved higher following the FOMC interest rate decision, with Fed policymakers now anticipating the Fed's terminal rate to be higher than what was previously anticipated, with the median rate by the end of the year now being 5.6% compared to March meeting at which it was 5.1%. Overall, the forward guidance provided by the bank tended to lean on the hawkish side, which may continue to weigh on gold's price. Furthermore, we expect the negative correlation of gold's price to the USD to be maintained and note as the next test for gold's price Fed Chair Powell's testimony before the US Congress on Wednesday and Thursday. Should the Fed chairman sound hawkish enough, we may see the precious metals price dropping even further. Furthermore, we would like to draw your attention to US yields as they have been on the rise in the past week. Should the US yields continue to rise, we may see the US bond market posing as an attractive alternative to the non-interest rate bearing precious metal and thus weighing on gold's price. Demand for gold from China seems to be easing as the recovery of the Chinese economy seems to be facing headwinds. It should be noted that China's trade surplus narrowed to 1-year lows as indication of fewer international trading transactions and thus lesser wealth entering the Chinese economy. Yet that could be a consequence of the contraction of economic activity suffered by China's crucial manufacturing sector. It's characteristic that the urban investment, industrial production and retail sales growth rates also down for May, underscoring the difficulties faced by the Chinese economy on its road to recovery. It's understandable that the investment of Chinese citizens in gold seems to have eased as the result of a weak recovery. It should be noted that analysts highlighted the role by China's demand for physical gold from China in driving gold's price above the $2,000 per ounce threshold. For the time being, we know that the Central Bank of the People's Republic of China's cut lending rates in an effort to boost activity in the Chinese economy, yet the cuts delivered may not be sufficient to revive it. Overall, should the difficulties for the Chinese economy to recover be extended, we may see gold's price weakening further and vice versa. Thank you for watching.